So the beginning of this episode got cut off a bit. So we're just going to dive right in. Dove into crypto because I need a new side hustle. Couldn't card count anymore, got banned everywhere.
Today we have a little dose of alpha.
This isn't going to be the average DeFi podcast.
We're going deep.
I think a lot of eyes were opened.
I mean, we're recording right now. I just traded $6 billion this morning.
Well, now things are driving towards business.
Wow, we're printing money. You excited for that? Market makers, protocols, chains, DATs, funds, and everywhere in between.
Casinos, you're on camera 24/7, like the whole time before you even step in the building. And so it just became a habit. Like you're always being watched. Surveillance is always calling down on you and whatnot. And a bunch of times like people would, lie and cheat and try to make accusations. Like I had several against me. I'm like, no, check the cameras. Like that is the same way police body cams now. It's like the good cops love them. It's the shitty cops that hate them.
Yeah, there's this, everything he says isn't great, but Malcolm Gladwell had a really cool piece on the, what did they call it? They called it the complaint, the cops roughing incidents. And it's like this Pareto's principle where it's like most cops have nothing. And then there's like 10% of cops have some. And then there's like the top 10th, like 1 in 10,000 cops. This dude out of Chicago who ended up getting arrested was a bad cop. He had something like 190 complaints of use of physical force. Like
that's a lot.
It's a lot. He ended up going to jail, was a bad cop, but like he had more it was like coming to the point where on his shift, it was like every third or fourth shift, he was having like a physical complaint against him. So there's like, everything is like Pareto, like the long tail.
Cool.
Use of force. That's what it was. Use of force complaints.
Yeah.
All right. So today on the cast, we have what is a money market and what is a CDP? Eric, money markets or CDPs, which is better?
Yeah, absolutely. 100%. I agree with you. Different strokes for different folks. They both have good use cases. It's really nice to see the evolution of CDPs and how they're coming out. I think there's a lot of long-term efficiencies that will be done through that. But money markets are just the absolute bare bones of lending. You borrow from somebody. You borrow an asset that they have from them at a rate that they're comfortable with. And at least here traditionally, it's fully secured. So liquidations can handle. They're safe. They're getting paid for lending to you. That's very straightforward. It's very efficient. We now have multiple types of it where it's isolated or it's generalized. Now we're getting fancy versions with V4 pools and things like Euler swap. But it's just straightforward. Somebody's got something. You want it. You borrow it from them and you pay them for that rate.
I think CDPs invented DeFi, right? If you kind of like look at the like Tether, I think Tether was one of the first original CDPs on Bitfinex. People wanted to hedge their Bitcoin exposure, right? And so there wasn't sophisticated money markets yet. There wasn't the ability to borrow and lend. You could still do the traditional finance like debt-free contracts, but there wasn't anything on DeFi. And Tether on Bitfinex basically became the first synthetic that was able to be traded, all backed by Bitcoin. But effectively, USDT on Bitfinex was the counterparty trading partner, right? And then they eventually tokenized that. So to be able to print USDT, you had to have Bitcoin. That Bitcoin had to be fully collateralized, and then you would borrow at a rate the USDT. Now, over time, they kind of shut that market down. They diversified into T-bills, Bitcoin, a bunch of different types of holdings. But that was like the original synthetic dollar. And then the second iteration for the CDP was MakerDAO. And this was on ETH. The first thing they took was ETH. This was a way very similar to Tether and Bitfinex. This was a way for people to hedge exposure to their DAI. What early on happened is people wanted more access to DAI. So what they would do is they would take their ETH, they would print DAI, they would take their DAI and buy more ETH. And then you got this nice, vicious, levered loop. And each loop that you go into, you're levering and pushing up the price of ETH because you're effectively like levering up on your ETH, which also gives you more exposure. What they found over a long enough time period was that they couldn't collect enough ETH and ETH reserves and hedge that appropriately. And so they started taking USDT and USDC as collateral as well. And now they have, I think, $6 or $7 billion into like all these different types of placements and rebranded to USDS of Sky, but the CDP is a wonderful construct in the DeFi ecosystem.
Yeah, it's really neat because you don't need a counterparty. However, without other types of counterparties, you're not able to maintain peg with what you print out of thin air. So at the end of the day, you can print something that's pegged to $1, but you can't buy a stake with it. And so you need to be able to liquidate what you mint to the dollar, and you don't want it to handle like crazy. So not only do you get to borrow against your own security, which is what you do through a money market, but you don't need a counterparty to borrow from, but you do need some kind of liquidity or peg maintenance. And that's something that gets really interesting for the CDP side that you don't have to worry about in a money market. What's your thoughts about pegs of CDPs in general, some of their risks, strengths? What does it mean to regular users? Like, should I use a money market or should I use a CDP?
I think if you're a basic user, looking at a money market is probably like the best first step. It's probably the most vanilla experience. You know what you're going to borrow, you know how much you're going to borrow. Things along those lines are pretty straightforward. As you get more sophisticated, you can start to build more interesting structured products around the CDP, because the price of a dollar, like of a USDC, if that's like 1-to-1 back, should be more expensive than a price to borrow a CDP. And if it's not, then there's something kind of like wrong with the construct of the CDP. Around the peg, there's kind of like a peg war that happens, which is really interesting. You could have a run on the bank. Now, what this basically means is, in a liquidation kind of scenario, or somebody that just wants to kind of gamify your existing CDP and doesn't want it to exist and wants to run it into the ground, they can eat up all of the liquidity and the counterparty liquidity around the peg, spiking the value of your CDP down. So trading out the CDP, a collateralized debt position, for those who don't know, it's the long things, but it's collateral, you create some debt, and it's a position that's worth $1. What you can do to attack it is remove all the liquidity, which will start to destroy the peg. And then your price goes down and the price goes down. Some newer mechanisms are really interesting around Liquity and Liquity V2 that allow for redemptions for the original collateral, which starts to create this like liquidation mechanism if the peg drops too low, which allows for a lot more stability. Previously, before this type of mechanism occurred, you could really only get the liquidity out of liquidity pools, and that was your peg maintenance. But liquidity is expensive to drive, so you also need some sort of redemption way to get the peg back if somebody attacks your liquidity pools.
Absolutely. The peg maintenance makes it more difficult. For an everyday user, money markets are nice, more straightforward and simple. When would they choose to use a CDP instead?
Lower interest rates. So if right now the interest rates are much higher on a money market, if you wanted to do less size, the slippage and the execution cost to go from your collateral, let's call it Ether BTC, into dollars on a borrowed rate is probably cheaper with the CDP. So you're paying less interest rates. So if you were like a longer term hold user, but currently most CDPs do not have the capacity as money markets and DeFi have. I think that's going to change over a long enough time horizon.
Interesting. So yeah, for the listeners, an analogy I'll use is like if you're trying to refinance your house, usually you are, borrowing from a bank, some kind of mortgage partner. So you're doing what would be a money market, not a CDP. But in that, you might have, say, a 0.25% origination or even a fixed price origination fee and then a 6% interest rate. Well, you might be able to instead, through a CDP, be able to pay a higher origination fee, where instead of like in $10,000, it might be $30,000 origination fee, but then a 4% interest rate. At some length of time, at some value of money, you end up saving a lot of money doing the CDP and doing the high interest rate instead. That realistically, for users right now, that might be like if you hold a position longer than a month, it makes sense. But if you're high frequency in and out, it doesn't. But there is some kind of math behind it with higher in and out expenses, but lower long-term sustenance.
Eric, what is bad debt in money markets and CDPs?
So we talked last episode about how I really wish that we were able to process some kind of bankruptcy, and that basically modern economies run on this concept that if and when things blow up, we don't tear down, we don't throw out the baby with the bathwater. We're able to say like, hey, you lose so much, the government subsidizes so much, everybody start over again. And we don't have that in crypto. It's a true zero-sum game. If there's a hole, if there's a hack, then that money is fully gone and everything built on top of it has to suffer from that. Bad debt is this concept of what usually leads to bankruptcy. It's where you owe so much money and you don't have the money to pay it back. And when you start creating an automated money market or a CDP, if the protocol itself accumulates bad debt, then the assumption is people are going to take all the money out, and whoever's left with something, some kind of deposits, whoever is left owed money by the protocol won't get it because the money's not there. So not only is it an inherent risk that now it is a fractional reserve that's not going to be made whole, but it's also, in theory, an auto-exposing fractional reserve, where as soon as it becomes one, it will cause the run on the bank that exposes it. If you think Terra Luna during, yes, its attack, but also, it could have been fine if people weren't worried about it for a short term. I'm not saying it wasn't a Ponzi, but the fact that it becomes a little bit exposed creates it to be fully exposed. So for a money market, it's if liquidations don't process in a timely enough manner. For a CDP similarly, or if one of the collateral assets in a generalized CDP goes down faster than the liquidations are able to occur, or at least the cascading liquidations, at some point there being debt that is owed to people and not money to pay it.
Yeah, that's interesting. It's fascinating to me. We talked the last episode about risk. It seems like to go back to liquidations. Like whoever liquidates fast enough becomes the winner in a contagion scenario. So it's like the risk of the collateral and then liquidations seems to be the components. Are there other components around bad debt?
Yeah, liquidations are definitely most important. Potentially bailouts. Then it goes back to a lot of what we talked about with risk. Understanding what can be a contagion. There's kind of this idea where it's more efficient. It's easier to get liquidity. It's easier to get liquidations if you're partnered with other protocols that also need them, kind of like buying in bulk. But then you're also at risk then of the other groups that you're partnered with. This is kind of what led to going from, like, say, Aave's generalized lending market to Morpho with isolated money markets, where right now, like, if one of the assets on Aave goes down and it collects bad debt, that bad debt influences all the rest of their markets, but you also just get a more efficient rate by using them. Whereas on Morpho, you can protect yourself from one of the other protocols going down, and you're only at risk of the specific market that you're having curated, but it's also just far less efficient, security versus scalability.
Yeah, so the invention of these isolated markets, what in particular is the issue with the isolation? Can you talk more about the scalability of it?
Yeah, so with isolated money markets, with less things that are borrowable, with less correlated assets, you have a new cold start problem. You have a new liquidity crunch problem. You have less flexibility in being able to withdraw because there's less money in there. So if you're at a 90% utilization rate on $1 billion market, there's $100 million you can withdraw. If you're at a 90% on a $10 million market, it's harder to move this in your $5 million size. So that's one risk. Oftentimes, depending on how it's curated, oftentimes the supplying rate is higher on an isolated market. Oftentimes it's lower. It really has to do with the collateral that's being borrowed against. But also, if you are a protocol that wants to borrow against your token, then you want to see, like, are you worried about the generalized risk, or are you just looking for higher capacity? Because if you're trying to go the isolated route, then you need to find a curator, which is expensive. You need to find other assets that should be curated with it. And then you need to source your own suppliers because you need to get the capacity to borrow against it. And it's difficult and it's expensive. And the more you're able to offload those expenses, which leads to more generalized, then the greater capacity, the cheaper it is, just the higher risk.
I think one of the biggest learnings that I had in the money market space is that even though you may have like a general market, like an Aave or a compound where they have 10 to 15 different assets in there, you're also kind of mispricing the collateral to a degree, right? So something like a Bitcoin, you could probably get a paper contract around 3, maybe 5%, but everything is priced at 4% on Aave, right? Which, as you go down the risk curve, each collateral, you can control it by LTVs, you can control it by supply caps, but everybody's borrowing USDC at the same rate. And what ends up happening is you have this mixed bag of collateral that may have different rates. So there's a purity in isolated markets, one collateral, one borrowable asset, but liquidity fragmentation is expensive. It's hard to attract that liquidity. It scales up, it becomes more mature, it becomes safer. You have this kind of construct, and from a curator standpoint, what you want is a 10 million or $100 million market. It's almost, if something's in a 10 million or below than 10 million, it almost doesn't even make sense to have that market exist because of the fees and the tooling that you have to do to like maintain it and look at it. Isolated markets versus general markets, I think it's always going to be like a toss-up. Feels a little bit like minor leagues versus major leagues. And there's like a collateral, there's an asset. It starts in an isolated market. It grows liquidity, it grows the amount of holders. And as it maturates, it starts to come into these general markets. So I feel like that's kind of like how these assets should think about it and maturate is like start small, get a little bit of leverage. Let's handle that leverage, get a little bit more leverage. Let's handle that leverage. And then it starts to go up. Is there any difference between this and the CDPs, or is it kind of like the same risks?
There's actually really similar risks around what assets you're able to borrow against in a CDP. So we work a lot with Liquity and Liquity forks, and Liquity itself with Bold, it's only ETH. But even in it just being ETH, there's 3 different versions of it. And our ETH does not maintain peg as well as, say, wrapped staked ETH because of how they do their peg maintenance and not being able to do redemptions. And then when you go on Liquity, you can see that the average borrow rate against our ETH is significantly lower than the other assets. And it's like, well, if it's still earning the same staking reward, why is it so much lower? And you have to go into, well, the spot markets against our ETH are really low. So when people start doing redemptions to maintain the bold peg, they're going to prefer to redeem against the assets that have better spot liquidity, which means that the borrow rates are going to press higher on those than they do on our ETH. And that's, potentially good for our ETH, but they're kind of, extracting against their competition for having worse peg maintenance. It's a kind of, it is what it is, not necessarily a feature or a flaw, but something that we need to look into, similar to, hey, I'd rather borrow at against Bitcoin at 4% than borrow against a grab coin at 4%. I might want a higher or lower borrow rate there, whereas Bitcoin might be 8% other places. They do have their own markets. And so you're going to attract different users based on rate arbitrage. So similar problems, but probably less direct using things like CDPs. Still, you have the issue of they are a generalized market based on whatever the stable token is. And if anything in that generalized market capitulates, then to a certain degree, depending on how fast and how much liquidations can occur, if one thing accrues bad debt, it affects everything else.
Yeah. I think what's really interesting is some of the experiments that we talked about running around helping RE maintain peg and have like a less slippage around using a CDP. And I think that's the difference between a CDP and a money market. Because of the generalized costs at a higher rate, you can drive more expensive to kind of do some kind of structured product building liquidity games on a money market than you can potentially do on a CDP. It's TBD right now. It's pretty experimental, but it's something that we should follow up on in the future. Who should use money markets versus CDPs? Do you kind of have like a cohort analysis of like users that you kind of think of, like what's better for each?
Yeah. In general, I think protocols should lean into more CDPs as ways to bury their token, trying to partner with solid CDPs and projects, but 2 with other solid collaterals. I think that's an easier way to scale, a cheaper way to scale, and at more size compared to cost for token berries, as we like token as a product type stuff. As a user, I think that high frequency traders, high frequency liquid needers, like if you're going to be moving quickly or you need to move quickly, that money markets are probably the better way to go. But if you're going to hold positions, like say a carry trade or something for a longer time, then like say over a month or 2 months, you could do your own analysis that you're going to get the cheaper rate with higher origination on a CDP. And so holding that lower rate over time makes it a lot better for you.
Yeah, I completely agree. I think over time, the CDP has infrastructure, as long as there's full reserve, it's not fractional AMOs, seem to be a piece of core infrastructure at DeFi that has not been fully utilized yet. Money markets, flash loans on Aave, high frequency traders, market makers, they understand the game around Aave and Aave's general markets across the board. I think originally, back to Bitfinex, they could not get enough dollars on the platform to make deep enough liquidity in order books for trading. So they had to print USDT, right? And I think the same thing is true for CDPs. It is that infrastructure that allows for deeper trading and deeper trading strategies by being able to synthetically print a stable coin. And so completely agree, protocols, asset issuers, they really need to focus on CDPs and building liquidity with these CDPs versus money markets, because liquidity is expensive.
Additional use case is going to be people who need consistently fixed rates or low rates. I mean, you can say leverage long with both of them, borrow against one asset, buy it back, supply it again, borrow against it. If you do that on a money market, when something like October 10th happens, then you're going to see really, really high interest rates. Your carry trades are going to run at negative. The unlooping becomes really expensive. If you do that on a CDP, it actually doesn't impact your rates nearly as much. So there's a lot more stability in holding longer term positions of any type, but that's something to factor. If you typically do looping on a money market, I strongly recommend looking into what those similar loops look like and the less risk that's available through on a CDP.
I don't think any CDPs got crazily affected.
Nope.
And depegged on 1010.
Pretty cool.
That's a
right?
really great argument.
Typically, it's argued that CDPs are less safe than money markets, but October 10th showed that not to be the case. Additionally, you mentioned last episode about oracles needing to be more decentralized. Typically, decentralized oracles would get wrecked from DeFi events. And so people use centralized exchange-based oracles to protect against that. All the decentralized oracles held up well. It's the centralized ones that broke. So maybe we are hitting this inflection point where decentralized is genuinely better and safer.
Yeah, I love that. I hope it's the case. I think it's the case long term. With good risk controls, the CDP over time should create synthetic stable coins that drive more capacity, especially for trading on chain. And maybe that's the overarching argument, which is the depth of liquidity drives the oracles as a better resource, as a better oracle and market rate oracle. But just to understand the counterparty is that if there's thin liquidity, market rate oracles, which is the rates and the markets on chain, if there's thin liquidity, they become more manipulatable. But if you start inherently from a CDP and you're building your liquidity from a CDP at the get-go, you kind of already know how deep liquidity that you can get and how protected your oracle is. There's probably a calculation in there. That's a really interesting point. Back to our other episode on oracles and how risky they are. What other risks do people consider that they may not understand yet about CDPs or money markets?
Yeah, for CDPs, just the peg maintenance, what goes into that, how do redemptions occur, understanding what arbitrage is or dilatory arbitrage is from different perspectives. We can say that you're minting $1 doesn't mean that that's actually the case. And a lot of CDPs I've seen come out and talk about how they can protect from being overpegged. It's never an issue being overpegged. How do you protect being underpegged? I'm not trying to purchase the token for the CDP. I'm trying to borrow stables, which means I mint for the purpose of exiting. So usually they tend to go a little bit under peg, which is what leads to what I consider the origination fee. So understanding fully what the peg maintenance is, how and why it's not going to wreck you. Then for money markets, it's really understanding the collateral. So this is a huge one from Stream Finance from October 10th. This idea that if you can print the synthetic dollar out of nowhere to borrow against it, even if you're doing a basis trade, it's like, hey, I'm happy to borrow at 8% because I can earn 10% elsewhere. Like that is efficient arbitrage. I don't have anything against that conceptually, but it's being disclosed as though it's secured lending and it's really a line of credit. Like I'm happy to take a home equity line of credit at 7%. If I could go take the money and earn 10%, I'm earning 3% for free. That's a basis trade. That is rate arbitrage. That makes sense. But that's not being disclosed. And the users who got hurt from that didn't know that they were at risk. So that's something to look into if you're doing this kind of stuff. If you're pursuing the highest interest rate you're finding on a money market, that's probably why.
Yeah. I think the biggest learning on this episode for me personally is like the CDPs and the oracles kind of go hand in hand. And if you want to kind of de-risk out of like a 10-10 scenario, building with the CDP, deep liquidity over a long period of time, making it sustainable will protect you and protect your asset from contagion risks. I think we need to spread that message far and wide because 10-10 will happen again. And I mean, this past weekend, we had a 20-25% dip. And so as these things happen once or twice a year, leveraging a CDP as part of your DeFi mix or protecting your token and your asset issuance seems to be a necessity going forward.
Yeah.
All right, Eric, we work with structured products a lot, a bunch of CDPs around building structured products around CDPs. Can you walk us through a structured product or a carry trade using a CDP?
Yeah. So first, like the idea of what is a carry trade? A carry trade is this concept where you can earn more money supplying something than you spend borrowing against something. It's kind of manufacturing yield through rate arbitrage. And this is really useful for stopping just holding cash under your mattress, which is what you do with Bitcoin and gold. The idea that it doesn't itself earn yield. You can't stake your Bitcoin. You can't stake your gold. You don't find more gold by having it sit there. So how do you earn yield off these assets that otherwise sit there dead? How do you get in the know? How do you do better with it? And fundamentally, it's through something like a carry trade. So the idea would be like, hey, you take your gold, you borrow dollars against it, you find somebody willing to offer you a loan at 7% interest, you pay them 7% interest, you then take the cash you borrowed and you go loan it to somebody at 10% interest. You make the 3% gap, everyone's happy. Now, we've talked here a lot about the differences between CDPs and money markets, and this is done often on money markets. And you're even seeing kind of fixed capped rates against Bitcoin specifically because there's a really high demand for Bitcoin yield, and it's really low because it's really only going to come from a carry trade. So with a CDP, you get a lower rate, higher origination, but if you're going to hold a position for a long time, the lower rate adds significant amount to the margin of operations for this. So if you can borrow against Bitcoin at 7% on Aave, then maybe you could borrow against it at 5% on Liquity. And if you're earning 10% with the dollars, then getting that extra 2% is going to make a huge, huge difference in the profit of your carry trade. So we're working with quite a few versions of CDPs and making structured products that do exactly this for Bitcoin, for staked versions of Ethereum, for other types of assets, where we can get really efficient borrow rates that are done and handled safely through like some of the safest versions of CDPs, able to manage and maintain the loan position, stop things from going under LTV, manage the borrow rates efficiently to protect against redemptions so that the collateral can be maintained. If you're putting in Bitcoin, the user wants to keep their Bitcoin. So we keep their Bitcoin protected because there's bunch of moving pieces, but then we take the dollars and we earn more with the dollars than we're spending to borrow them.
That's excellent. So carry trades, structure products, CDPs. Eric, thank you for your time today. This was awesome. And that was a dose of alpha with Eric and Bryan from Alpha Growth.